2024 is gold year to shine. I'm going to give some arguments why I think that's true, and I'm also going to address some of the, I won't call them myths, but some of the concerns that people have about the market, about gold stocks. The most important graph, and Ronnie Steffler had this one earlier in his presentation. The most important thing is that to understand is that gold really starts to take off when the Federal Reserve stops tightening. Now, it strikes me, and it's not just the Federal Reserve, of course, it's central banks around the world. Up here, the Bank of Canada, as you can see here on the red line, they've held rates steady for the last few meetings, and some of them are talking about cuts in the year ahead. Now, I think most people in the gold business perhaps are a little too optimistic right now about the timing and the severity of rate cuts by the Federal Reserve and other central banks. I think the market is just a little bit optimistic right now. In the US, they have something called the Fed Rates Futures, where investors will bet on what they think is going to happen. And for the March meeting, which is the next meeting after January, they don't meet in February, the March meeting, the odds are about 50-50 right now. The problem with 50-50, of course, is that whatever the Fed does, it's a big surprise to half the market. For December, it was like a 90% odds that they wouldn't raise. So they didn't raise and, nothing untoward. But I think the market's a little optimistic right now. But I think if we look a little bit further ahead, I think they probably will cut rates in March, but they'll definitely cut them at the following meeting, which is May, in my view. I said the gold investors are a little bit optimistic. So are the broad market investors. Because most people in the US today, most investors in the US today are thinking there's going to be no recession, no landing at all. And, I think that is not just grossly optimistic, but is just plain wrong. Even people like Janet Yellen, the Treasury Secretary, who is a labor economist, she said, well, we're not going to have a recession because unemployment is so low. And that is just about as fallacious as you can possibly get. If you look on this graph here, it is very, very clear. This goes all the way back to 1950. It is very, very clear that the unemployment rate is at its absolute low point immediately before a recession. And that's important to understand. So where we are now, with unemployment as low as it is in the US, does not in any way mean that we're not going to have a recession. If anything, it suggests that a recession might be in the offing. The other thing that a lot of what I call apologists or mainstream people say is, look, we've had tightening rates. We started, 20 months ago. We haven't had a recession. We've escaped a recession. And people have been talking about the Federal Reserve doing a victory lap. Again, that is just totally fallacious. If you look at history, and Jerome Powell, the Federal Reserve Chairman, keeps talking about long and variable lags. But how long are these lags? We go all the way back to the 1960s, and you can see that the average length of a lag between the first rate hike in a rate hiking cycle until the start of a recession is 27 months. It's a little bit distorted by the last one, December 2015. But nonetheless, even if you remove that, you're still looking at 20 months. So we are only barely, we're not even at the average yet of the time that it takes a recession to start from the onset of rate hiking. And I think as investors generally, and frankly generally in life, when we expect something to happen, we all tend to expect it to happen sooner than in fact it will. These things take time to work through the economy. And if anything, we should expect the time lag this time around, the time lag from the rate hiking to the recession, we should expect that to be longer than normal, simply because we had 12 years of excessively easy money and ultra low interest rates where households and corporations were all able to refinance. You know, people refinance. In the States, you have fixed rate mortgages, 30-year fixed rate mortgages. People, every household you know, refinance their mortgage at a lower rate. Corporations refinanced and termed out their debt. So we entered the rate hiking cycle, household and corporations entered the rate hiking cycle in much better shape, meaning they're much more able to withstand those higher interest rates. And, you know, if we just think about it for a second, the company, for example, took on debt or refinanced their debt at 2019 when rates were at zero, and they did 5-year rates. They have a 5-year term. They haven't been affected by higher rates yet, other than how it affects their customers. But it's when they have to refinance that debt next year, and the rate goes from LIBOR, whatever it's called now, it's not called LIBOR anymore, but LIBOR plus 3 to LIBOR plus 3, it goes from 4% to 8%. That's a very, very significant increase. And you're seeing that across the board. I don't think I brought a chart this time, but if you look at the debt maturities of US corporations, this year is going to be pretty much double last year, the amount of debt that's maturing. 2025 is going to be double 2024. So the next couple of years are really, you know, the key point when all this debt starts to mature. And that is one of the reasons, corporate debt, and that is one of the reasons why I don't think the Federal Reserve can continue to keep rates, you know, let alone higher. They won't be raising rates, but they can't even afford to keep rates where they are because of all the debt that's coming due. Now, so I think it's all but inevitable, because nothing is inevitable in life except death and taxes. But as they say, but it's all but inevitable that we're heading into a serious recession in the US. Now, some people immediately say, oh my gosh, we're having a recession. What's that going to do to gold stocks? And that's a sort of the immediate reaction most investors have, is that gold stocks will do badly in a recession. But in fact, again, if you look at history, I'm a historian, by the way, not an economist, that is simply not true. This is every recession in the US, and we focus on the US because, of course, it's the largest economy in the world. You look at every recession going back to the beginning, to the end of the 1960s, you see the gold actually rose in every single recession. Now, all I'm doing here is looking at the official recession, National Bureau of Economic Research. They define a recession. I'm just looking at that time period. Every single recession except one, gold rose. And the one where it fell less than 0.5%. And that was in the early 2000s, if you remember, when all of the European central banks were busy selling gold. So not to make an excuse for it, but that was an unusual period. If you look at the gold stocks, you see that in a majority of recessions, they were up. By no means in every one of them. But in a majority of recessions, they were up. And the interesting thing is, look at the recessions when gold stocks are down. They're down by 3%, 5%, 6%. Look at the recessions where gold stocks are up, and the returns are very, very phenomenal indeed. And the interesting thing is that, again, in all but one case, look at the comparison between gold stocks and S&P. But gold stocks are outperforming in every one except one. In every recession except one, gold stocks outperform the S&P. So the lesson from this graph is you almost definitely want to have gold in your portfolio during a recession. You most likely want to have gold stocks in your portfolio, and you definitely want to have gold stocks rather than the broad market. What's the logic for this? Well, the logic for this, of course, is that in a recession, profit margins get squeezed. Profit margins of a broad market get squeezed. And so the S&P see a decline in their earnings. Stocks don't do well. But why do the gold stocks do well? The gold stocks do well because in a recession, markets are forward-looking. So in a recession, people look ahead and say, what's the Federal Reserve going to do and other central banks when we have a recession? They're going to start cutting rates. So gold stocks go up, not because of the current situation, but because of what investors think is likely to be the response of the Federal Reserve. But in any event, the facts speak for themselves. So we're definitely going to have a recession. Gold stocks and gold do well in recessions. What about inflation? This is the US here, the US CPI. And I've headed it stubborn. Obviously, the CPI has come down a lot over the last year. Some of that decline, of course, is from the base effect. If you have an increase in inflation and then inflation stays level for the next year, the year-on-year comparison begins to get weak. But look at what's happened since June. You know, it's by no means a runaway freight train, but the trend is slowly moving up. And I think inflation in the US is going to be very, very stubborn. And think where we are now with inflation, even though the price of oil is so low. And the price of oil, of course, obviously goes into gasoline and to, airlines and transportation. But the price of oil affects the price of every good in the stores, because everything in the stores has to be transported. It's either transported a short distance or it's transported a long distance. But the price of oil is a critical component of the price of goods in the stores and what's called inflation. It's not really inflation, of course. Inflation is excess liquidity from the Federal Reserve. But anyway, the prices will go up. And so the mere fact that we've seen the prices of goods and services, the CPI, hold steady and move slowly up, even though the price of oil is so low right now, I think suggests that we're going to see higher inflation over the next year. And as we get to that period where we're comparing with March, April, May, when CPI was lower, and we're comparing with those, then the base effect works in the opposite direction, and the CPI starts to go up. What is this? Oh, yeah, this is Canada. And you can see here, again, the same sort of thing. But the inflation level came down dramatically, but October, November, they haven't issued December, or at least they hadn't as of Friday. Don't know why it takes so long, but anyway. And you can see it's slowly moving up again. But again, look at June, look at November, and it's moving up. And that's true of most countries around the world. It's true of Britain, for example, where they had an inflation shock earlier this month. This is gold and inflation in the 1970s. Why do I have that? Oh, I know why. Yes, because you can see that halfway through this cycle, inflation was coming down. The Federal Reserve stopped raising rates because they thought they were well on their way to killing inflation. And then the CPI just took off, and with it gold. And that's exactly what we're seeing now. Remember, 18 months ago, Jerome Powell was very, very clear. We're not going to stop raising rates until inflation is at our 2% target. Now, 2% is an arbitrary number anyway. And if you're looking for sound money, you don't want 2% inflation, you want 0% inflation. But even if you take it at their own target of 2%, he said, we're not going to stop raising rates until we're at our target. Then it was, well, we're not going to cut rates until we're well on the way to achieving our target. Then it was, well, once we see a clear path to our target, then we'll start cutting rates. Think about it. In the US, the last core CPI, which is the Federal Reserve's own preferred measure of inflation, but the core CPI, that's for people who don't eat or don't have houses, is 60%, it's 3.2. That is 60% above their target. How can you say you've achieved victory when you're 60% above your own target? It's not a target I picked for them, it's their own target. So we're a long way from killing inflation. And that's what we're going to see here. Gold and recent inflations, people say to me, oh, you know, when inflation goes up, gold goes up. Yes, yes and no. If you looked at this graph here, it's a 2-year graph of gold and the CPI in the US, the CPI change, I challenge you to see any correlation between what the CPI is doing and what gold is doing. But the important point is there is no contemporaneous correlation between gold and CPI and gold. But if you move the gold price 6 or 9 months over, you get a very, very close correlation. And so CPI coming down suggests gold comes down, but then when they think they've achieved victory and stop tightening, then gold starts to move up. And so the scenario that I've suggested, I haven't really said it, but that I've suggested is a stagflation. And that is the scenario I think we are most definitely going to get in the US, in Europe, in Britain, and probably in some other countries. And that is a recession with stubborn inflation. Now, a stagflation can be a modest recession and runaway inflation. It can be a sharp recession and just stubborn inflation. But we're going to get a stagflation. In my view, we're going to get a stagflation in the United States. And in a stagflationary period, gold does very well. Gold is your number one performing asset. Oil also tends to do well. Resource stocks tend to do well. And emerging market stocks, incidentally, do well. But the emerging market stocks typically will do well when the stagflation it comes with a lower dollar. If the dollar is strong, emerging markets probably won't do well. And the developed market stocks and bonds are the worst performers of all. So a recession, almost certain, but we don't have to be worried about gold and gold stocks in a recession. A stagflation, in my view, almost certain, and that is a positive environment for stocks. Now, we've talked about the grocery cart at the bottom. A lot of people say, well, you know, there's been a war. That's good for gold, isn't it? In fact, no. Geopolitical events tend to have very short-lived impact on the price of gold. And, you know, I'm thankful for that because, you know, I don't want to profit from other people's misery. But so I can ease all your consciences. But when you have a geopolitical event, and geopolitical events are normally bad, of course, when you have a geopolitical event, the price of gold can spike, but they tend to be very, very short-lived indeed. So you won't have time to see all of this. I'm happy to send slides, by the way, to anyone that emails me for them. It's assetmanagement@adrianday.com. You can look at all these, the Lockerbie plane, 9/11. They have the Gulf War. You can see even when the event is totally unexpected, like 9/11, the impact on the gold price is very short-lived indeed. And often what happens is you have warning of a geopolitical event, and the gold price moves up in advance of that, and then once you have the event, it comes back pretty quickly. Nowhere is this clearer seen than in whatever that was. Time flies, doesn't it, when you're having fun. But in the Russian invasion of Ukraine, when they were amassing troops at the border and there was all this conversation, will they invade or won't they invade? I honestly didn't think they would invade, but that's an irrelevancy, what I think on that issue. But there was a lot of concern. Gold moved up. As soon as the tanks rolled in, you get a spike, and then 2 months later, you're back below where you were last year. A lot of people say to me, oh, yes, but when you had the Israeli response to the Hamas terrorist attack, then gold spiked. Yeah, gold went up, but it went up in response to other events. It went up in response to growing conviction that the Federal Reserve was going to cut. So I think it's as I say, it's almost certain we'll have a recession. Very, very positive for gold. Most likely a stagflation. Very, very positive for gold and gold stocks. I think the downside in gold stocks now is as close to zero as you can possibly have. That does not mean they're all going to take off next week. Again, I think the market is a little bit optimistic on the extent of rate cuts. But give it a few months to the second quarter, I think we're going to start seeing a very strong gold market. And the email again is assetmanagement@adrianday.com. Thank you very much.